Welcome to the BF Anderson Technical Report for November the 1st. The stock market is never obvious. It is designed to fool most of the people most of the time. Jesse Livermore, famous investor back from the 1920s. Livermore also said, "Don't fight the tape." Being in cash or having high cash levels in your portfolio is something that I have found over the years to be a difficult process because clients really prefer to stay invested all the time, which I prefer. I love the stock market, so I want to be in stocks. But there comes times where the odds are so stacked against you that survival and portfolio principal protection becomes really the priority. It's like if you were a ship's captain and you knew that if you went out of the harbor while the tides were out, that you ran the risk of running aground and ripping the bottom of your boat out. So you wait for the tides to come in, things normalize, then you set sail. So let's get right into the charts, because the way I believe to deal with the trickiness of the market is using trend following. And trend following has been a real positive force for me because it keeps me in tune with the health of the market. So the first graph here, again, this is the NASDAQ composite. This is a daily graph. You can see that we've had pretty much a waterfall decline, pretty dramatic. Moving averages have all turned down. This is a downtrend. Now, call it a bear market, call it a bad market, a birdie market, whatever you want to call it. I'm going to call it a downtrending market. So when you're in a downtrending market, it's very difficult to beat the odds. The odds are really stacked against you. Now, as we pointed out last week, this really got started because what we're looking at here now is volume, daily volume on the NASDAQ. So what you want to see, of course, is real big above average volume on up days and real low below average volume on down days. Well, on the 23rd of September, we got this enormous amount of down volume, 3.5 billion shares traded on the NASDAQ on the 23rd. So, we've just kind of limped along. We had one really kind of good day in here, but then we followed right the next day with another distribution day. So you can see that there's really more distribution going on in the market than accumulation. Now, yesterday we had a little bit of accumulation. We traded around 2.8, 2.9 billion shares, and that was somewhat of an improvement. So this could be the beginning of a bottoming process. But I would keep an eye on daily volume. And if you see these really big down days on extremely high volume or above average volume, and what I've got here is a line which is the 50-day moving average for volume. So when you're above that line, those are above, average volume days. Now, here is the weekly NASDAQ. This is plotting the price of the index on a weekly basis. And you can see starting in October, we had 1, 2, 3, 4 weeks in a row of institutional distribution. Because when you're seeing here 12 billion shares a week, now that's not your Aunt Sue. That is major institutions, pension plans, and so forth. Now, so far this week, we've still got to go till Friday, but so far this week, things are kind of looking to the green. Now, an indicator just to kind of keep an eye on, this is an indicator that I watch called the New York High Low Index. This is the New York Stock Exchange High Low Index. And it's a calculation where we take the number of new highs divided by the number of new highs plus the number of new lows. And it's basically just trying to come up with a way to monitor, are we getting new highs here or are we getting new lows? Well, you can see that we're basically in the tank. There are no new highs. We're getting a lot of new lows. And, that's just showing you that the market's just not healthy right now. Now, if you get back above 30, a reading of 30 on this index. Now, this index, by the way, we're plotting it on a 10-day moving average so that you kind of smooth things out. But you can see that really we've seen no new highs and a lot of new lows. Now, another way to look at this is something called the New York Stock Exchange New 52-Week Low Index. Now, these are the stocks on the New York Stock Exchange that are hitting new 52-week lows. Well, you can see here back all during the month of October, we were getting readings of 400 and 500. So the basic rule is, and the back study that I know of, is that you really want to wait for the number of new lows on the New York Stock Exchange to start getting below 40. That's where this line is. And yesterday we only had 62 new lows, which is one of the lowest, the best readings we've had in a while. So what we would like to see would be the number of new lows stabilize below 40 and start to maybe, think that the market's put a bottom in. Now, this is the long-term index that we use called the 1020. This is the 10-month moving average versus the 20-month moving average. You can see that the market, basically hit a top, made a new high, and it's now come down quite dramatically. Now, this is the S&P 500. So we are now below the upper moving average, which will pull this moving average down. Now, what we don't want to see is something called a death cross, where we get a cross of the 10-month below the 20-month. That would be somewhat of a long-term sell signal. You can see here back in 2000, we had a death cross bear market. We had a death cross here in 08 bear market. Now, we had a little mini bear market in here around 2014, 2015 that pretty much bottomed right after the election. But this indicator is starting to show some signs of weakness. It's going in the wrong direction, but let's see if it holds. Now, back to sentiment. If you look at the graph in the report that's attached today, you'll see that we're still in extreme fear with a reading of 7. Now, last week we had a reading of 6. That's pretty dramatic. So what we're starting to see here is fear coming into the market because people are buying puts, not buying calls. This is what the institutions use to hedge their portfolios. They really can't use cash like we can because we have flexibility and liquidity. So what they do instead is they hedge their portfolios using options. And so when they get really emotional and paranoid and thinking the world's coming to an end, they start buying puts in a dramatic way. Well, you can see here back in the summer, we really got, a good dose of pessimism here. So, this could get worse, but it does look like it's trying to turn, and we'll just have to keep an eye on that as well. Now, we've been keeping an eye on Amazon as one of the prior leaders. You can see the stock is really broken down here. This big drop right here was the day that IBM announced their largest acquisition in the history of the company, a company called Red Hat, which is in the cloud computing business, which would compete potentially with Amazon Web Services, which is one of their most profitable businesses. So you can see here we're continuing to see this downtrend in the leadership. Now, Apple is a little bit of an exception here. Now, they announced earnings today, so we'll have to see if it holds. But so far, the stock is holding up around 218, 219. It did break down below 210, which was a key area, but really, actually, 212 was the key area because there's the bottom of that prior base. Then you had another base. So Apple doesn't look great, but remember now, the stock is not the company. The company is the company and the stock is the stock. And if institutions are selling for whatever reason, they're going to drive your stock down. But Apple is holding up somewhat better. Now, I'm going to get into the top 5, and I'd like to say this. This is a watch list, and I would also say this is even a pre-watch list because I just think we're a little early here and we want to just be careful because there could be some head fakes. Like I said in the beginning, the market fools most of the people most of the time. And if you think about that quote one more time, if a market just did nothing but go up all the time and never fool anybody, then it wouldn't be a market. Markets move up and they move down. And what the market wants to convince you to do is to buy at the high and sell at the low. The market wants to take your money. So you got to have tools like we've been going through here. You've got to have tools to give you an edge, and also don't hesitate to use cash as a hedge. Having cash is an asset class. Now, this is Endo Pharmaceuticals. This is a $17 stock. It looks okay. Now, here is a company that we've been following and a little disappointed in. Intelsat announced earnings. Stock really kind of tanked. It doesn't look that good. So, we just, like we're saying, this is a pre-watch list. Now, one that did break out yesterday that I'm finding very interesting is Nordstrom, which is a brick and mortar retailer, but I believe, if I'm not mistaken, they're getting very strong into, the web-based stores, the e-commerce stores. So you can see here you had a top at 66 and it broke out. Stock looks interesting. I think that's one to really kind of keep an eye on. Here's a pharmaceutical, Eli Lilly, looks okay. Here's a oil and gas. In fact, it's Petrobras. I believe they're Brazilian. Yes, this is a Brazilian oil and gas producer. $16 stock. Not really my thing. I'm not really big on energy stocks. But so all in all, what I'm saying is that keep your powder dry. There's no rush. When the tides turn and you want to set sail, you'll see it in the charts. And so we'll be monitoring this for you every week. And just let me know if you have any questions. Thank you very much.